Hey everybody, welcome to Stock Abilities. Today I'm going to be covering my SPY strategy with the puts and the calls, and I show some proofs at the end of the video of kind of the transactions that I made and a rough estimate of what you might get based on your capital level, so stay tuned till the end. Before I get into all these here, all the circle things are kind of what I'm going to be covering today in this video. I'd recommend checking out the Discord channel here. I got Stock Chats, which is a broad live chat alert. It's stock news, stock alerts, option alerts, sports alerts, stock watch list, research, education, long stocks, updates on the current portfolio, and a bunch of other stuff, and a lot of people in particular throughout this video or this channel that can help you with your stock trading, options trading, all that kind of stuff. So I'd recommend checking it out. I got a Patreon too if you'd like to support that. I'm not going to get into too much details about that, but it helps to support the channel and the video during the duration of which AdSense isn't monetizing any particular videos in regards to the channel, and Discord doesn't really donate me any money as well. So if you want to support either of those, just check them out in the link below. We're going to jump into it though. In order to start trading with Tastyworks, you actually need to have a broker account with them. I'd recommend putting in at least $2,000 minimum. I use a cash account in particular, but some of you might prefer a margin account if you want to try out some other strategies in there that may be more lucrative but more risky. You got the opening trade, which just costs $1 a trade and $10 max per leg, which is basically 100 contracts. 100 contracts are just an obligation to buy a particular option or sell it, or however you intend to do it. I'm going to be talking about buying calls and buying puts. I'm not going to get into details about all the other specifics. There's some applicable fees, as you can read here. It's usually up to like 30 cents per each option. But we're going to get right into this here. The long call option in particular is what I generally do. The IV is pretty much the implied volatility, which is the assumed volatility or the given movement of the stock or ETF or whatever you might be playing. As you can see with the copper bar in the middle here, this is kind of like a volatility measurement based on the options movement. There's a little bit more to it, but I'm going to keep it pretty simple. That essentially this is the range you want to watch in. The tighter this range gets, the less volatility, the more it's going to be stuck in a particular area, and the more likely that the option premium that you are in is going to dump. You got the volume here, which is just the amount of volume per each contract on each expiration, and expiration is essentially you're obligated to buy on that particular expiration if you like to, but you don't have to. It's just an obligation. You can buy and sell the premiums. That's essentially what I'm going to be covering in this video. You buy the call premiums, you buy the put premiums, and you sell them before they try to execute them, which would mean that you would be buying a particular amount of shares. One contract is basically the obligation to buy 100 shares. Most brokers, if you don't have the money in your particular broker account, they won't go charging you all of a sudden. They'll likely close out your position before the end of the day. If your option is expiring, I prefer same day expirations or within the same week. You got the pop percentage down here. Pop percentage is essentially the expected move 1 cent up. In this particular one, there's a 30% chance of that happening. You got the delta. Delta is essentially the assumed movement if the stock goes up $1. So if it goes up $1 from its current point, you're expected to make 40 bucks on each given contract. So if you have one contract, you're expected to make 40 bucks. If you have two, you're expected to make $80. Now this is kind of a rough estimate. If it breaks into an in the money area there, then you might make potentially more, depending on how much it spikes and how quickly it spikes. Theta isn't going to be relevant to this video, but essentially theta is like a decay rate. The longer you hold an option on multiple days until it's closer to expiration. But since this video is going to be about buying and selling the particular option on the same day, that's not going to be relevant. The max loss is pretty common sense. You buy a position at 37 cents, which is basically you have the obligation to buy 100 shares, so that's why it's $37 is the cost for one contract. So essentially, the more contracts you have, that 37 is going to double, triple, and whatever. If you buy one contract, right now it would be $37. If you buy two, it would be like 70s somewhere. You get the point on what I'm going on with that. You got the buy to order and sell to close. That's what this thing is here on the bottom left. And the 1D means basically 1 day till expiration. The particular expiration I'm highlighting is the August 6th for SPY, which is an ETF, kind of a core markets. But that covers about all of this here. The bar in the middle, the volatility, the bar on the left right next to there, that's if you bought the option now, anytime below this point here would be red, you'd actually be losing money. Obviously the green indicates that you're going into the money. There's an ITM, there's an ATM, and then there's an OTM. The at the money essentially means that you're buying right at the strike price for right at what the given stock price is. The in the money means you're buying a stock expiration or a stock strike price at the particular price above that. So if you're, let's say, I forgot what SPY is exactly. I think it's like 283.60 or something. If you buy an in the money 283, that's an in the money because you're literally in the money with that particular option. If it dips below 283, that in the money becomes an out of the money. And if you are buying, let's say, at 285 and the 284 go or 283.60 goes to 285, that all of a sudden becomes in the money or at the money if it's right on that particular strike price. Other than that, they're all pretty much self-explanatory. Usually, if you have a break from the out of the money to in the money, there's more of a bigger percentage of profits depending on how fast that volatility shoots up. Generally, you're on like a kind of a clock that the later in the day that you hold that particular option, the more likely you are to actually lose money because the volatility cools off as it gets later in the day. A lot of the big movements right in the morning, sometimes you can only get it from 9:30 to like 10 in the morning. Sometimes it lasts up till noon, kind of depending on what the news is for the day. I'm going to get into all that here in a second. This is a little bit more of a clarity into what I was saying with the expected move. You got the loss to break even point, which is essentially where you probably bought at, and then the profit point. Obviously, the risk here is that if the volatility goes down, the option premiums do too, so you still can lose money even if the stock does absolutely nothing or just simply goes up but at a slow pace. Obviously, the volume on the left is kind of an importance. There is also essentially a potential volume that you can look at too. It's called open interest. Doesn't mean that people are necessarily going to buy that, but it might give an indication. You could switch from the volume to the open interest tab by just clicking on it. You can go in a little bit more details here. The Monte Carlo analysis covers the pop percentage, but pop percentage is like a quantitative data set based on other data that's gathered up and an assumed movement from that. It's kind of complicated, kind of not. I find it sort of helpful at least to gauge a sort of an idea of the potential movement, but I don't really go too much into detail in looking at that. Got the pop percentage with the selling options. That's not what we're really talking about today. Pop with buying options is the relevant one. You could read into this here. I'm not going to go into much more detail about that if you want to check it out, but it's not super relevant to the strategy. Going a little bit further here, some of the indicators I use. I do use different volume indicators of different sorts. I'll be covering that more in another video, but try to find an indicator that works for you that represents a particular volume percentage in like a movement and in a range that you can kind of see where the big volume is and where the little volume is. Somewhere in between there. I bounce between a lot of volume indicators, so I can't really recommend a specific one to you. If you guys are curious, pop me a message on YouTube or on Discord, and I'll dig up the ones I've used in the past. But it's all up, really kind of depending on your preference. The general rule of thumb is to get out as early as possible because most of the momentum is going to be in the morning. Something else I look at here, and it kind of goes with the Fibonacci thing that I'm about to talk about here, but you got the range of the pre-market. This is the previous pre-market, but I'm just going to use it as an example. It's 283.25 to 288.12. So the pre-market on Friday, this was the particular range, and it only closed a little bit above this. I usually go with the 61.8% Fibonacci. You can use an indicator. I often just use a calculator or just kind of a rough percentage in my head in regards to the assumed movement. But the calculator I use, I'll post in the video description below. I use the pre-market highs, the pre-market lows to get a rough idea of the Fibonacci level, and then you can kind of, from previous days, get a rough idea of the support levels potentially. But there's certain degrees of oversold, essentially RSI, which you can read about as well if you'd like, but it's basically the equivalent of the stock or the ETF is oversold to a certain point, and it's a retracement level. I use pivot points as well, but I don't really rely on them on a day-to-day basis that much. Mostly use volume indicators and the expected move, and just a lot of common sense depending on the given day for the news. Like Apple just reached $1 trillion, so the trend is your friend essentially, and it was very likely to continue to go up. I'm going to jump into the next part here. Something else I look at is the economic news for the given week. Monday doesn't have very much, so it's going to be a very weak or kind of a downturn, or the option premiums aren't going to be shooting up too much. Tuesday is a bit more promising with the JOLTS report and the consumer credit at 3 p.m. You got the petroleum report on Wednesday. You got jobless claims, a few other things on Thursday. I'd say Thursday is looking to be the most likely promising day. Fridays are usually bad because everybody's selling off into the weekend. This isn't exactly an ideal week to just start doing SPY options, but it should be a little bit safer because you're going to be trading in a much tighter window, so the risk is a lot less, but at the same time the reward's going to be a lot less as well. But essentially I look at these, I look at the overall economic news, going a little bit further into that. Show you guys here in just a second here. This is just general news that you can look up general headlines through NASDAQ. You can go through CNBC and all these other major publications. I wouldn't read too much into what they're saying, but what you want is a headline for a particular stock that's more of a core market stock is what I'm trying to get into here. The more of a core market stock, essentially, the more movement you'll get on SPY, the more movement you'll get on QQQ, which is essentially tech associated. Not sure why that wasn't loading there for a second. This is SPY in particular. As you can see, the biggest movers for SPY would be 26% of technology. So if you hear big tech news, you're likely going to see a rise in SPY. So that's a pretty helpful fundamental indicator that you should be getting into it. Apple is the biggest core of SPY's holdings, which is why it helped move it up. On Thursday, I believe it was, when they announced the news that essentially Apple hit $1 trillion. Might have been Wednesday, I could be wrong on that. Something else I use here, I don't use it too often, but it's an options profit calculator. There's tools on Tastyworks that helps with this, but you can throw this in here to get a better idea of what you may be receiving if you buy a particular option at a particular price. This covers a lot of different strategies that you could be doing. There's covered calls, naked calls, long calls, naked puts, all that kind of stuff. Top 10 trading mistakes here. I just want to throw this in here. You don't got a trading plan. You don't give in emotions. You don't have patience. You're not going to work out too well with this kind of stuff. Take a look at this and kind of brainstorm and think it over, and think of how your trading is, and make sure you're not doing any of these. As I said, the trend is your friend, so keep that in mind and continue trading to the best of your ability. That about sums up everything I wanted to cover in this particular video. I don't know if there's anything I really missed, but if there is, leave it in the comments below. The only other thing I was going to mention is that I do have a lot of bullish patterns memorized technically, hit that. I'll post a video about that in below if you're curious as to different patterns you should look for that are positive, which also help with your trading. Thanks for listening in, and have a nice day.